On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Great music, great soundtrack.
It is a great soundtrack. I don't know why. It sounded like it was playing twice, and it completely threw me off then. I don't know why. It sounded like it was playing twice.
It is playing twice, actually. I can hear an echo.
It is playing twice. Why is that playing twice? Let me figure this out. Do you know why? Because I've got it open on another window, which is why we are hearing ourselves twice. So what is a webinar without a couple of hiccups along the way? So let me introduce ourselves. So my name is John. I've got Lindsay as our co-host today. I'm super excited today. Super excited today because
Likewise.
This is our first co-hosting webinar together. We've been planning this for a little bit. We've had some chats offline which have been really fruitful, I think, and really kind of like cool to have chats about markets and stuff. So I'm super excited about today. We're going to be talking about a very popular asset today, which is gold. And I'd like to think I've got a lot of experience in the gold market. Have you got much experience in the gold market, Lindsay? Do you try gold often?
No, I've never had to do it directly myself, but a lot of my experience was in retail brokers and managing the risk and the positions of a lot of those. And of course, it's consistently in the top 5. Like every time you get one of those daily trading reports, you're going to see gold up there in the top 5. If you ever saw a day where the amount traded was more than 50% of the total, you would not think that was a mistake. That's something that can very easily happen. So it's one that's very popular with people as well. Because I think people like trading currencies. They're something that's easy to understand. But if you want that little bit of extra volatility where you can make and also lose money a little bit faster, then gold is actually one that's people find quite exciting. And also the fact that it's just continuously made new highs. It feels like, I'm going to say like 3 or 4 years, but seriously, it could be longer than that, right? Like how many times did it make a high and you think, oh, this is too high, and then it just makes another one. I remember not that long ago, it was significant that it broke through 2,000.
Yeah.
Where's it now? It's at 5,600 like a few weeks ago.
I know it's quite an interesting asset to talk about, especially with what's going on right now. I think that's why I think gold has such a pull, because it's influenced by obviously a lot of the geopolitical tension and all that kind of stuff going on at the moment. But it's also, like you said, a very liquid asset, very volatile asset, and it can move very quickly. So I think that's why people are very excited when they kind of start trading. I feel like they start maybe on the Forex pairs and think, this isn't as quick. They'll probably see the change on the day, probably like 0.25% or 0.5%, max 1% if there's been some significant news, and then they flip over to gold and it's just absolute carnage. And I think that's why they really love it so much. But before we dive into those sort of key elements of gold, I just want to make sure that everyone can hear us first. So if anybody is watching, please type a 1 in the chat. We do have a couple of little things to go over before we get into it as well. So the one thing to mention is that we do have a bonus for traders that are watching and staying to the end. There's going to be a code word that we're going to give. And if you pass that over to our CX team, then you're going to receive a $20 trade credit bonus if you are an Anzo Capital verified user. So let's dive into it a little bit. Let's get into our lovely presentation here. So we're going to be talking about gold. We're going to be talking about what really drives the market. And this is what I'm super excited about today, because I think a lot of people start with gold and they think, oh, I'm just going to go and try a little trading strategy. I'm going to be, buying highs or whatever, or selling highs, buying lows and all this kind of stuff. But there are some real drivers behind gold, and I'm excited to learn more about it. I'm very glad that you're here to help me with this as well. So
I think I'm going to be doing more learning than you today, but we'll see.
So before we go through, the agenda for today is we're going to check out those macro drivers, which Lindsay is very much going to take us through as well. I'm going to talk a little bit about some correlations in the market. So we're going to be talking about sort of the dollar index. And I know a lot of people see the dollar index and think straight away, oh, that's a correlation with gold, and they kind of keep the two charts side by side. But sometimes that correlation can fade a little bit. So I'll talk a little bit about that as well. We're going to go into some potential sort of trade setups, or at least some analysis and some case studies that we've seen in the past. I mean, we can obviously talk about the current situation that's going on, and some potential levels that price is trading at the moment, because gold has actually dipped quite aggressively recently, and there's been a big question around why that is. I think that's I've seen that question so much. I was scrolling through Twitter yesterday, and it was like the number one question I think I saw was, why is gold dipping at the moment? So
yeah, it's a very good one.
Yeah, we could talk a little bit about that as well, because I actually think people don't realize how gold can dip in an event like that. So there's a couple of case studies that we can talk about as we go through. And then we're going to go through to some Q&As and hopefully get some questions flowing through. I've got a couple of questions for Lindsay myself, so I'm going to keep those to the end. So prepare yourselves for those. And then, yeah, we'll get to the bonus at the end. So remember, it's just going to be a code word that you can pass on to our CX team. So let's get into a little bit about us. You know, you may have seen our faces more recently. We've been doing a couple of webinars. Lindsay most recently on trading misconceptions, which went down really, really well. So yeah, I'm gonna take a seat back here, Lindsay. You introduce yourself first. I'll introduce myself after, and then we'll go from there.
Okay, well, most people know me as Lindsay, but as you can see, my real name is Lindsay McCow. I've come from quite a corporate background, so I actually been in finance for 20 years now, so that makes me super old, but the vast majority of that was...
You don't look it.
That's just all the camera enhancements you can do before. But I started in investment banking, actually, so a lot of people end up in the trading department of a retail forex broker, coming through the operations department, or maybe coming through sales or customer service. But I very much came in directly to trading because I started off in investment banking at Macquarie, which is the largest investment bank in Australia. And then when I moved over to trading, I started my corporate journey at Susquehanna International Group, which is the quantitative trading firm out of the US, founded by professional poker players, focusing mainly on options as well. And so eventually, when I found my way over to retail FX, I took a lot of the macroeconomic understanding from investment banking, and also the game theory and the understanding of financial markets came from my time at Susquehanna. So that's why I think about trading a little bit differently to a lot of people in forex trading. Can be good and bad, because I think sometimes there's going to be some bits of terminology that you'll be surprised I don't know, just because that's not the way I'm used to referring to it. But I also think that being a contrarian, now obviously this has its limits, but I think being a contrarian can actually be beneficial in a lot of ways. And I'll use a poker analogy here, where if you're at a table where everyone is a little bit too loose, you actually want to tighten yourself up. That's the ideal strategy, and that's how you can exploit that. And vice versa, if the whole table is a little bit too tight, you actually loosen yourself up a little bit, and that's how you exploit them. So if you have a strategy that is not ridiculously bad, it can actually pay to be a little bit different to conventional wisdom in the market, because the opportunities you see won't disappear quite as quickly. Yeah, one of the things I've told you, John, is I really enjoy the chats that we have, because even though we came at this from such different angles, the way we think about trading is remarkably similar, which gives me actually a lot of confidence that I'm on the right track. Because if I can come in from this angle and you come from this angle, and we're kind of in the same pool, then what are the chances that we're both wrong? Like, it's still greater than zero, but it's significantly lower than it might otherwise be.
No, that's true. I mean, thank you. That kind of like bigged me up a little bit then. I was actually going to say, I actually feel more comfortable when you say that I'm on the right track because of your background and history, whereas I've had the traditional
Positive feedback.
Yeah, positive feedback route. Yeah, but yeah, I had the positive. I had the relatively sort of, I'd say, typical retail forex trader starting route. I'm very much self-taught, and I think this is where I think I can kind of relate to forex traders that have been through it quite a lot. So a lot of people that go through and open accounts and lose capital quite quickly. I know how they feel because that's exactly where I started. I didn't have the finance background initially. For me, it was kind of like I had a very strong passion for the markets, and it was like, how can I just learn as much as I can about it? And I just tried to be a sponge. I was very fortunate to be able to talk to some good names in the industry, and I'm very fortunate to be able to be sitting here right now and chatting to you who've had such good experience as well in the market. So thank you for that. I mean, I'm here. Yeah. Well, that's it. I'm here today to. You don't realize what I've got is a notepad next to me. And when you're talking through these macro drivers, I'm going to be like, oh, yeah, this is cool. I'm writing all this stuff down. So
extra pressure on me.
Yeah. I like to add a little bit of pressure. So that's cool, though. That's really nice. So let's go through. And we kind of touched about this a little bit earlier. We touched about the fact that why is gold so popular? It's so popular because of that high liquidity. Gold is one of the most liquid markets in the world, right? And with that, especially when it comes to kind of CFD brokers, we can have tight spreads, fast execution, all that kind of good stuff on an asset like gold. And I think, again, that's why it's so popular. The massive volatility, and you can see just from this chart here, this was a recent screenshot that I took, I think it was last week, might have been the week before, but you can see the massive volatility that we've had recently. And that is both good and bad. And I think the good is where people can kind of take advantage of that volatility without having too much risk on the table. But a lot of the times it can be a little bit bad. So I'm hoping actually today, although gold is a very popular product, we can actually give some people some insights into maybe the correct way about thinking about what to do when they open their chart, when they open gold. I was always kind of taught, try and find the why before you open the chart, right? So think about, we know gold is a volatile asset, and one of the things recently obviously has been the geopolitical situation between the US and Iran, and the escalations there. And I think many people would think, oh, that has to be buy gold, right? And that's where they've gone into it. They know that the market's going to be volatile because of that. Yes, initially we did see some gaps higher, but that soon has faded, and now people are starting to panic. So I think one thing that we can do today is really kind of highlight that it's not as easy as just that logic of, oh, something bad's happening, go buy gold. There is a much deeper sort of meaning behind it. The other thing is it's easy to get involved with. Brokers make it very accessible to get involved with gold, and to try and trade that price action as well. So yes, gold is a very popular product. Why? I know we kind of touched on it earlier, but do you think there's anything else that makes it such a popular product? Is it because it's euro dollar, I guess, or like FX pair? It can be quite complicated because you've got to focus on sort of two economies.
Versus, actually, that's I think you hit the nail on the head. I was going to say something like that.
Yeah.
I think I said something to you. I don't know if you remember this, because I'm sure you remember everything I say. But I think I said something like, people tend to like trading or focusing on things that they think that they understand, and gold is something that I mean, a lot of us have gold. Like we're both married. My wedding ring has gold on it, so I actually have something gold with me all the time. Whereas if you're trading a currency pair, like you may be trading the euro, but it's actually possible that you've never touched a euro in your life. So I think when people have it sounds really silly, but when they have like some sort of connection to it, they think they understand it, they're more likely to go into it. Maybe euro is a bad example. Swiss franc might have been a better one because a lot of people will never touch one of those. But yeah, I think it's just, yeah, it's everything you said with the liquidity, but I think there's something a little bit familiar, or people think it's familiar as well.
No, you're right. I remember you saying that now because it did resonate with me quite a bit because I thought about it a lot because one of my first trades that I ever opened was soybeans long, and
That's right. Yeah.
I was kind of like, I don't think I've ever really touched a physical soybean in my life, or I didn't even know the history really of soybeans, you know, before I traded it. And I think that's ultimately why I got destroyed, because I didn't realize that there was a very, very sort of seasonal situation going on at the time that was really impacting that market. And I just got involved because it looked good, you know, and I got destroyed. But no, I get that, because, you know, I think that's why I trade the pound quite a bit, because I'm based in the UK. So I feel like I know kind of the situation on the ground. You know, sometimes what I like to do is just I go take the wife out. We go into town a little bit and go for a couple of drinks or whatnot. And I actually try and gauge how busy the place is where we're going, or like how busy the shopping area is that we're going, because my wife likes shopping. So, you know, I always, you know, we have to go shopping at least once every 2 weeks. So, you know, I actually try and take those moments as a little bit of like my own personal economic gauge, if anything. Because I'm like, well, if all of these people are out here and it's super busy and people are spending their money, then the economy can't be that bad, right?
Yeah, so it's like your real-time indicator.
Yeah, or people might have disposable income, or people are just leveraging up on credit. So it's just quite an interesting thing to think about, and I think you're absolutely right. People can physically touch gold. I'd say majority of people could probably get their hands on some kind of gold element to it. I know there's a lot of gold that used to be in sort of computer devices and phones and all this kind of stuff as well. So it's a very very accessible product, I guess, which makes it interesting. But let's move on. We're going to talk about a little bit about the key driver. This is going to be my favorite part, I think, of the webinar. So I'm going to move the slide over. I want to hear about these fundamental drivers. I think the safe haven is something that I don't know. Do you think a safe haven is misconstrued? Gold can be misconstrued as a safe haven.
It's yes and no. So I think mostly it is not misconstrued, because it is. So I've always thought of three broad fundamental drivers. Like, I know there are a lot more, but maybe my brain can only handle three, or people like hearing about things in three. So I always think of them in three. And the safe haven is the one I think of first, not necessarily because it's the most important, but when I first started specifically in Forex trading, so remember, I came from a trading background, but not Forex trading initially. When I first started, gold very much acted as a safe haven. So what I mean by that is, anytime there was a risk on day, you would see equities, so stocks would go up, bond yields would go up, certain currency pairs would go up, like the dollar yen, for instance, but gold would go down. So you would see a very clear correlation where if markets were risk on, gold went down. If markets were risk off, gold went up. And so the safe haven theme or narrative is one that's always stuck with me, because, you know, you never forget your first, is what they say. So when I first started trading, that's how I thought of it. And so you can see in the graphic, demand spikes during war, economic instability. Absolutely. So with the Iran conflict, the very first move. So it happens. We have a very good way to gauge this, because the war was actually announced over the weekend. So it trades 24/5. We could see what would happen on the gap up when the market opened on the Monday. It was clearly up. And I have a feeling, and I can't confirm this, but I'm about 90% sure that the same thing happened during the onset of the Ukraine war as well. The initial move was a gap up. But as you flagged earlier, gold has not been a one-way street during the Iran conflict, and very much the contrary. And I think that segues very nicely into the second one here, which is real yields. So if you think of yields as just interest rates, that can be an oversimplification, but it's actually not totally inaccurate. So for anyone who doesn't want to get too deeply into the weeds, just think of yields as interest rates. The reason I put the word real in front of it is because if you think of interest rates as, let's say interest rates are 5%. If inflation is currently going at 2%, then that 2% return, 2% of that 5% return is only compensating you for rising prices in the economy. So your real rate of interest, your real return is really only the remaining 3%. And that's that real rate of interest, or that real yield, is really what matters. And this might be a bit of a tangent, but in general, for financial assets, if yields or interest rates go down, the value of the asset goes up. And if interest rates go up, real interest rates, I mean, the value of the asset goes down. And this is it's very obvious for something like property. I don't think I need to go into the reasons why that's the case, but it applies for everything, and gold is no exception. Now, if anyone who's watched my previous webinar knows, I like to go into little side anecdotes. So I'm going to stray into the only one that I've really got planned for today is when I first started out, I mentioned that I was an investment banker. And when you're a junior investment banker, you do a lot of not very exciting work and stuff that takes a long time. But financial modeling was one of the core things that I had to do. And we were buying and selling companies, but we also owned and held a lot of these companies and managed them on our books and derived performance fees for doing so. And so I was in charge of the valuation model for a particular asset. Actually, most of our assets were in the UK, not in Australia, which is where I'm located now. But this particular asset was an Australian asset, so it's an Australian company. I won't mention which one it is, but we knew that compared to 6 months ago, the value of the company had to be higher. It had to be higher because the business had done better than we expected 6 months ago. All our growth projections were either the same or higher. We just knew that all factors pointed to the valuation being higher. So I updated the model, went into the pre-meeting with the rest of the team, showed them the result, and the number was lower. So of course, the managing director, the CEO of the fund, the CFO of the fund looked at me and said, "Lindsay, are you sure this is right?" And I said, "Yeah, it is. And it's because interest rates have gone up." And when I told them that, they were like, "Oh, of course." So that's twofold, because they knew I was right, and they knew that there's nothing that we could really do about it because I had done it correctly, but because the discount rate or the hurdle rate had gone up, the value of the asset had gone down. So they stopped and had to think about it for a few seconds, and they said, "How about," and then I won't go into the details, but they thought of a reason why we could lower another part of the interest rate or the discount rate on this particular asset. And it was good enough for me that I didn't feel bad doing it. So what they said was, "Okay, Lindsay, go and change the interest rate or the discount rate, lower it by 50 basis points, tell us what it is, and if it's acceptable to us, then just add an extra paragraph to the board paper explaining why we did what we did." So I did all of the above, went and updated it. This time the valuation went up, and it happened to go up by an amount that actually made a lot of sense, I guess, intuitively based on what we were expecting. And actually the difference was a little bit more than $100 million. So you can see 50 basis points, 0.5% can make a huge difference.
Wow. Nice, dramatic difference.
Exactly, yeah. So added that to the board paper, explaining why. It wasn't that hard because I thought it was a very justifiable reason. Then when we went to the board meeting a few days later or the next week, explained it to the board members, and they said, "Yep, sounds good." And that's what we used in our results presentation, and that's how we paid ourselves a performance fee. So
nice.
I guess that's a little peek behind the curtain of how things can work. I guess the key there is the impacts that yields and interest rates can have is quite a lot bigger than people would expect. I guess the tangential thing to take away from this also is if you're ever wondering how specific a financial model is that an investment bank spits out, it's incredibly detailed, but also very flexible, because one little tweak here and there and a few assumptions can make a huge difference in valuation. So sometimes you do have to take it with a grain of salt. But let's bring it back to gold. So if yields go up, that can cause the value of gold to go down. And this is what has been happening here. And I don't want to take too much away from some of your future slides, because I think you're going to talk about this as well. But essentially, because the price of oil has spiked so dramatically, and that's causing inflationary effects and also inflation expectations to spike in economies around the world, but particularly in the US, that is causing yields to go up, and that is what's causing bonds to go down. And I think a similar dynamic played out in Ukraine as well, simply because that also happens to be a region, so not Ukraine specifically, but Russia, who had sanctions put on them. That is also a very oil specific or oil heavy, I'm trying to think of the right word, but everyone knows what I mean, but you can help me with the right word. But oil is very much driven by economies like Russia and the Middle East. And so when yields go up or inflation expectations go up to compensate for this spike in oil price, that can cause the price of gold to go down. And that's really what we've been seeing. I'll come back to that in a second. The third factor that I generally think of is one that I'm going to just touch upon very briefly, because I know you're going to discuss it next, is the US dollar, simply because it's priced in the US dollar. But I won't say any more than that. I think the thing that people want to know, and you touched on this earlier as well, is what do you do with all this information? There's three different factors. What if some of them are pointing in one way and some are pointing in the other direction? And I'm not going to have a good answer for you here, because it depends, right? One is not stronger than the other. And as you know, and as anyone who's traded before knows, sometimes they're all pointing in the same direction, and for some reason the price still goes the other way. So you've done all your analysis, you're so confident that you're going to be right, and it just doesn't go the way you think, which is why, as I said in my previous webinar, it doesn't matter how good you think your analysis is, you generally want to see some evidence from the price action that either your thesis is correct, or that the rest of the market has caught on to your thesis as well. Because you can be correct, but if the rest of the market is wrong, they can stay wrong for longer than you can stay solvent. Actually, I actually rewatched the Big Short recently as well. And that's basically what happens to.
Yeah.
It's a classic, but it's basically what happened to those guys. Like, they were correct about the mortgage market, but the rest of the market was incorrect about it for much longer, and the premiums and on their swaps just kept eating into their profits until eventually they were able to cash out on a profit.
Yeah, that's interesting. So I like when you said then about all these, one factor's not necessarily as strong as the other factor. So what I would say to that is, at the moment, obviously gold is not acting like a safe haven, is it? It's acting in line with the inflation shock coming from oil. So oil at the moment is just the main driver. Like, as soon as oil moves, everything else moves, right? And that's kind of what we're in this window at the moment. So in that type of situation, how would you know kind of which one to lean on more in that situation? Is it because you can see that yields are rising that you would say, okay, well, yields are obviously rising here, this is more of an inflation story, versus it being that sort of safe haven initial shock?
The answer I'm going to give is one of those. It's simple but not easy, easy but not simple, simple but not easy. So it's very simple. It's the price action. So the market tells you which one is the dominant narrative. So for the first day, it was the safe haven narrative, and basically every day since then, it's been the yields. And actually, if you want to go, there's three main drivers, and let's take the majority. the US dollar has been rising as well, ironically, because the US dollar has been the one that's been acting as the safe haven, not gold. And there's that inverse relationship, which you're going to touch on as well. But the safe haven narrative indicates gold should be going up, but rising yields and rising US dollar indicates that gold should be going down. So you could think of it as two is bigger than one, and that's why it's been happening. But honestly, I think this is a situation where it's a really good illustration of why fundamental analysis and technical analysis have to go hand in hand, because you do the fundamentals and we're not wrong about what we said, but you have to look at the price action and let the market tell you which one is the correct one. And again, it's at any given time, because this could turn tomorrow. This could turn in tonight's session. Who knows? It's not what I'd be predicting, because generally you want to go with the trend until you have some clear evidence to the contrary. But for now, it's decided that yields in the US dollar are going to be the drivers of gold rather than the safe haven narrative.
Do you think if, and I know I'm kind of going a bit off topic here because I'm just kind of being a bit selfish and just going to ask some questions.
Yeah, sure.
But do you think then, so, because I know the market's kind of moving on a tweet at the moment, or a Truth Social post, if we're going to talk about the main man himself. How does the market see a risk of, how does a market price the risk of that? You know what I mean? That element of surprise of whatever Trump might say in a tweet. Because I was looking at the market yesterday. I've been very much on the bearish side of gold because yields have been rising. The US 10-year yield broke out of a significant kind of technical level and has been rising. And I was like, well, this typically feeds into bullish dollars and all this kind of, as we've been kind of talking about. And I kind of like the idea of gold shorts. But then obviously he tweets about, oh, we're making really good progress with Iran, blah, blah, blah. Yeah. Market spikes, right? How do you price that risk?
Or
can you?
I mean, yeah, so I guess the short answer is you can, but is it, in a practical sense, is it worthwhile? And I guess for most of us and in retail trading, I mean, you could build yourself a complex financial model, build in the probabilities and stuff, but I really don't see how that's worthwhile. The way to protect yourself against it would be simply to have stops in the appropriate position. Yeah. That's, again, it's not a surprising answer, and it's maybe not as insightful as people were hoping, but that really is it. And honestly, like, the banks could have their own models as well to try to model this, but how are you going to try to model that tweet or Truth Social finger? Like, you just can't. Like, sometimes, like, how many times have we seen he says something and then directly contradicts it, or one of his key economic advisors says one thing, or his treasury secretary says one thing, he says something else. I think, wasn't it just last week where a trade representative tweeted something and half an hour later just quietly deleted it from their account because they'd spoken too soon? So you can't, and that's why there's, I mean, it's actually a great environment for trading, because there's a lot of volatility. If you can, have correct bankroll management and correct risk management, there are a lot of trading opportunities. We saw this during the first 4 Trump years, and we're getting it all over again. So a lot of opportunities, but yeah, I just don't think in a practical sense you really can. Obviously, theoretically, you can price for these, but in a practical sense, I don't think the cost benefit is there for the time investment it would take. You just have to be prepared to take the opportunities when you see them, and just know that, if he says this, then the movement will probably be this. And if he says that, it'll be this, but how much confidence can you take? Well, it depends on what he says. So being prepared for those, sure, but getting a specific number, I think, is going to be very, very hard to close to impossible for at least individuals like us.
Yeah. We'll circle back to this later, because I'm quite surprised at how sort of gold has been behaving since he's kind of talked about this, because in my head, it's like, well, nothing is confirmed, from these conversations he's doing, or tweets that he's having, or Truth Social posts he's doing. So how much of this move can we believe in, that we're seeing in this kind of rally in gold? So we'll circle back to it a little bit later. We'll talk a little bit more about the dynamics that come with gold, and then we'll go on to some charts and some case studies, because it's definitely an interesting sort of dynamic of how a market can be influenced by certain actions, but is the bigger picture something that you should make tradable, if that makes sense, right? So what I'm saying is, if Trump tweets, market reacts, is it more likely that we should fade that move because the consistent sort of other narratives are, I guess, more foundational, if that makes sense?
I think I know what you're. I think I know what you're asking.
Yeah.
I just don't know if you want me to answer it now, or if that was just a nice segue into the next slide.
Do you know what? I'm going to segue into the next slide, and we'll circle back to it. All right. So let's jump into the most famous sort of correlation, I think, and that is the dollar index and gold. Now, the reason is gold is priced in dollars, so naturally people would be, oh, okay, well, when dollar's strong, gold is going to be weaker. When dollar is weaker, gold is stronger. And that usually does happen. But there are certain times where that logic can disappear. It's not the perfect inverse relationship that I think everybody believes in. And I think I chose this screenshot here to kind of demonstrate that, because you can kind of see the two different narratives. So from like February to March, the dollar and gold actually moved in tandem with each other, which is not necessarily something that people would believe in. So they would probably go to their, and I know this because I've spoken to a lot of retail traders. I've sat with a lot of retail traders that do this. They have a dollar index chart open, they have their gold chart open, and they're trying to trade the inverse relationship. They're trying to trade that correlation. And sometimes it works. And I mean, there is a saying that, all of it works some of the time, right? Which is probably my my sort of logic around a lot of things that happen in the markets. But I think it's important to know when the correlation is strong and when it's not strong, right? So between February and March, it wasn't a inverse relationship. They were moving together with each other. And a really simple thing that a trader can do, just sort of practical, is put the two charts together, overlay them. Instead of having them separately, have them overlaid together, and you can really see that relationship. Now, obviously, that relationship has changed recently because of the situation where it comes to what you were talking about with inflation, right? Inflation has, or the expectations that inflation is going to rise and there is going to be that supply shock, that has created the momentum into people wanting to be owners of the dollar rather than necessarily being owners of gold. There also could be a bit of a liquidity issue as well. Stock markets have been falling, usually in those situations as well. Gold can take an initial hit. I mean, gold prices have risen substantially. You might see people that are needing to kind of cover their backs, and if they are hedging with gold, then they can at least take some of the profits from that and push that into the business, or into cash flow at least. So there's a lot of different dynamics, but what I would say is the dollar index and gold, you've got to remember what the dollar index is, and that is a basket of currencies against the US dollar, right? And it's heavily weighted to the euro. Yeah. And I think this is where we can get that separation. And I think this is where traders can get confused. So they will, instead of just thinking about the dollar index as, oh, that's what the dollar is doing, it's not really. It's what euro dollar doing. It's what, all these kind of currencies that are in that basket and heavily weighted. It's what those markets are doing. So I think that's a really important thing to think about when you're looking at this relationship when it comes to gold.
That's bang on. If you didn't bring that up, I was going to say it, because when I found out how the basket was comprised, I was stunned. And this was only a few years ago when I actually looked into it. It's more than 50% euro.
Yeah. It's actually, because I remember looking into that because when I first looked into gold back in the day, it was saying look at the relationship with the dollar index, and I was like, well, what the hell is the dollar index? So when I researched about what the dollar index was all those years ago, I was quite surprised. I was quite surprised how many currencies made up this basket. I was surprised about certain weightings to that. I was, so usually, if anything, your dollar index and your euro dollar is probably a better relationship than it is with gold. So if you want to use if you want to use the dollar index for anything, probably should be used with euro dollar trades, to be honest. But yeah, I thought it was an important thing to note that it's actually heavily weighted to the euro, and that's why you can get these separations as well.
Yeah, very much so.
The other thing is as well, I want to talk a little bit about silver. Right now, I don't know if anybody has traded silver, but I actually last year, surprisingly, actually have not traded gold for about 2 or 3 years now. That might come as a bit of a shock, but I ended up trading silver instead. And the reason was because I feel like I missed out on the move on gold. So I kept telling myself that, oh, gold's too overpriced, and it kind of kept me out of the move. And it was almost like, as well, when we saw that kind of parabolic move on gold through sort of 2025, there was very minimal sort of pullbacks on that move. And I found it very difficult as kind of trying to think of where am I going to put my risk. I was thinking about from a strategic point of view, where am I going to put my risk? And I couldn't really work that out. So in pops one of my little favorite ratios, which is the gold silver ratio. Now, just by the definition there, you can see that it's how many ounces of silver it takes to buy 1 ounce of gold. And I really like this ratio because it can give us some really clear signals. So I know our session today is about gold, but I also want to tell people that silver has a 70% or just over 70% correlation with gold. So usually what we'll see is that gold can sometimes be a little bit of a leader in price, and then silver can sometimes try and catch up with it. Now, silver is a lot more volatile than gold. It's not as traded as gold, so where the moves are a little bit more exaggerated that we can see in silver. But what you can see from this gold silver ratio is that every time it makes a high, it's basically saying that gold is more overvalued than silver, right? And every time that a high forms in this chart, usually it's met by a low in the silver price. So this is how I was trading silver over the past year or so. I was waiting for the gold silver ratio to reach a significant high. And as it started to turn, that's where I bought the dip in silver. So I think I actually traded, if I remember my stats rightly, I think I traded silver 22 times last year and only had one losing trade.
Long. Yeah. If you were going long most of the time, that would have been very juicy.
Yeah, there were only longs.
There you go.
But that's another thing to kind of bring yourselves into when you're thinking about, maybe you're looking at the gold prices and you feel like you've missed out on the move. Maybe you can look at a different asset that is correlated with it, so that there's a potential opportunity elsewhere. I know there's other correlations around as well that a lot of people talk about. I don't think those correlations are as strong. Sometimes I know gold has a strong correlation with the Australian dollar. But sometimes those can move again against each other depending on what's going on in with the RBA and the situation in Australia and whatnot. So although I did actually overlay a chart before coming into the session today of the Australian dollar and gold, and they are actually pretty correlated at the moment. So I love talking about correlations because I think people don't look at them enough, if that makes sense.
Yeah, no, it's a very easy way to, easy, but like if you want some structure to your trades, which really everyone should have, it's a very good indicator when something is out of whack. So yeah, I can totally understand that. Actually, the question I was going to ask you was, every time you saw an opportunity to go long silver, did you ever consider doing both and going short gold and long silver, just to sort of cover your bases in case one move?
I didn't. I probably should have, but I don't necessarily think about hedging that much. in terms of that. Honestly, I didn't want to stand in the way of gold. I had
Yeah, actually, I can totally understand that too.
strong feeling that gold was going to do what it was going to do, and I mean the evidence was on the screen for a lot of the time. So I don't really hedge that often, and I think again that's kind of like, I guess, a difference in how traders see things. I think retail traders, especially, I would consider myself very much a retail trader. We don't necessarily hedge at all, which I don't know what would you hedge in that situation? If you were buying gold, would you think about hedging in that situation?
It's more that I wouldn't think of it as a hedge, because if you think of it as like a dislocation in the two markets, but you don't know which one's off. Like, let's say the gold silver ratio goes, which way are going to go? It goes up, right? So gold is relatively more expensive than silver. Without any further information, you wouldn't know whether it's because silver is too low or gold is too high. So by going short gold and long silver, you're not really banking on one or the other going up or down. You're actually just banking on the ratio returning to its long-term or medium-term average. So I guess that's the way I would approach it, because you're right. Like if you have a trade that you're confident in, I'm actually okay as long as you've got the correct risk management parameters in place. You don't need to hedge it. It's more that I would have thought to trade it as a pair in this case. But I could totally see why, if you're going to only do one, you would do the long silver and not the short gold. Like, that's kind of a no-brainer, and that's how you approached it.
Yeah. Well, I was also thinking about risk as well. I guess adding more risk would be to take those two kind of positions. So what I like to do, I like to break my trades down into like 3 and then almost kind of like dollar cost average into the move. So I'll try and, like, so if there's a, with those silver trades, I'll always try and see if I can get a little bit of a better price. If not, then I'll probably try and buy into it as it's kind of going with the momentum again. So yeah, I guess I just didn't think about selling gold at the time. But it could have been
obviously it would take up more. It would eat up more of your margin as well. So there's all these other considerations as well. There's a lot of good reasons why you wouldn't do it. I was just curious on your specific one.
I mean, I guess I could have looked at like a sector, or kind of like maybe like a mining sector or something, or some kind of mining stock, silver mining stocks. That could have been a way of maybe looking at a different way of applying risk as well. But I'm not a predominant stock trader, I would say. I'm a very, is the right word, passive stock trader. I like to look at how the stocks are performing relative to what they kind of do. So like if there was a silver miner or whatever, I like to look at how they're performing versus what's going on with the silver price and stuff. Like, oil spiking at the moment, so airlines are likely going to go down or whatever. So you kind of marry those kind of situations together, sort of thing. So yeah, I just thought I'd put that on. I didn't realize how long we're going, so I want to get us through this a little bit. I'm going to skip through the next couple of slides because I think everybody kind of knows these. The best time to trade gold, I'm going to say mine. Lindsay, I'll let you say yours, but I'll just say the US session. Are we aligned on that one?
I tell you what, it's definitely not the Asian session, but yes, US session. Yeah, I mean, there's that period where the London and the US sessions overlap. So for obvious reasons, when both sets of traders are going, that's going to be a very liquid time as well.
Yeah, cool. Let's move on. So we're going to go into a little bit of some catalysts. Well, I want to pick out a couple of case studies. So I know you kind of talked a couple earlier. So I want to kind of show those as well. But just to kind of break it down, this is a sort of strategy that I like to implement, or a method that I like to implement. And I think this is a method that people can use when they're trading gold as well. So if they're going to go to the chart and just open up gold, draw a few levels on, I don't think it's not a bad thing to do, but at the same time, there's more elements, more layers that you can add into it. And like at the start of the webinar, I said, I really like to think about the why behind an action. Actually, I think it might have been before we even started the webinar that I was talking to you about this. I like to almost know the why before going to look at the chart. And that's always how I was kind of taught to look at things. So, you know, for instance, I know that in the or the British pound futures at the end of March to April has a very strong seasonal rally, right? That could be a why that I want to go and look at that chart. Then I go on to the conditions. Does the conditions match up with the why or the fundamental catalyst or whatever that is? And if it does, then we can start looking to apply a strategy. And that's how I want us to think about gold. It's almost like, why could price do an element? Do those conditions line up with that to give us a little bit more of a bit of confidence that maybe the bias that we're thinking about is actually forming? And then how do we apply a strategy to it? So a good way to think about this, if we go dive into a little bit of a chart. All right, now let me just add this gold chart in. And this kind of comes back into what we were talking about earlier, right? And sort of inflation expectations and whatnot. So I'm actually going to go back in time a little bit. And we're going to look at the Ukraine-Russia situation.
Okay.
Right? So we actually saw, let me actually go to a weekly chart just while I bring in the other elements as well. So this is a weekly chart of gold. Okay, now this is the week of the invasion of Russia into Ukraine. Okay, so as you said, initially we had that sort of spike higher because we had that sort of safe haven reaction. And then from that, we had a little bit of a catalyst where the market then sold off aggressively. So in that situation, it's almost like, well, why did that happen? Right? Why did we get that little bit of a move up? And I've got an actual little bit of a line up here. So now this is the Fed funds interest rate.
Okay.
So what we actually saw in 2022 was the Fed funds interest rate was rising. Okay. And what happened really with gold prices initially was that we saw that sort of sell off. I mean, if we look at it from 2022 to 2023, we didn't really do much. We just kind of went a little bit sideways. Market wasn't really doing much. We bounced from the highs up into the 2050s, down to all those 1640s, back up into the 2050s, and then kind of dropped through. And then what you'll notice is as interest rates, I mean, look how far I have to stretch this chart out. This is a weekly chart. But as interest rates kind of held and we started to see changes in the economy, which then led to interest rates coming in lower, we started to see gold start to rally off the back of that move in there, which I just thought was quite interesting because we're talking about sort of inflation expectations at the moment. And usually if inflation rises, then a central bank is going to look to hike interest rates, especially if it's persistent like it was in 2022, which causes gold to really, if you look at the bigger picture, move sideways, right? It is pretty much flat throughout this entire period here. And then as soon as we start to see sort of inflation coming in lower, we start to see the central bank looking to decrease interest rates. And as we decrease those interest rates, this is where we really started to get that kind of big drive, really, in my opinion, is where we started to see that sort of huge rally come out of it as Fed funds rates start to move lower. Am I on the right lines there, Lindsay? I'm going to bring this to you.
Yeah, no, it's totally valid. I guess I've been trying to think, why did interest rates start? I'm just going back. So this is the FOMC. I guess you can't see the chart there, but this is just the US cash rate essentially.
Yeah.
Yeah, I'm trying to think what the reason for that was. And actually, this was the post-COVID. So COVID is when central banks around the world went lower. And then as we came out of COVID, they all started normalizing and going higher, right? And that's the period between the two red lines. Yeah, that actually makes sense. And you can see that gold's trend is clearly up. But as John said, it sort of trends a little bit during that period where rates are rising. So it's kind of like the brakes were put on, but it wasn't completely stymied, because once they were done with the rate hikes, then its upward trajectory resumed. So for reasons that were not totally related to the Ukraine invasion, we saw gold sell off. But then once that yield narrative took a back seat, then you can see what happened after that.
No, absolutely. And this is kind of what's happening a little bit now. But obviously, we're looking at the Fed funds rate. They don't change the rates too often. But it all comes down to, I guess, expectations of what's going to happen with the market as well, because the market wants to be forward looking, right? It always wants to try and think about what's going to happen in the future. So if we look at what's happening with sort of oil prices at the moment, I mean, it's been a bit of a choppy time. But oil prices have gone from $64 topping out towards $120 recently. Now, what you can do on TradingView, which is quite cool as well, is if we can compare, we can actually come in and type in not CPI. And if we come in and just go to economy, okay, let me type in, let me see if it can come up as US CPI, right? United States Consumer Price Index. Just put that on a new pane. I'm going to zoom that up a little bit. There we go. Probably need the month by month really, rather than the US CPI. I've not done this one in a while. Where is it? United States Consumer Price Index. Let's see if it's this one. Right, this was the one. So you can see when oil spikes here, the US CPI follows along with it, the year on year, right? And then we can see as oil comes in lower, inflation moves lower. So this is the problem we've got right now, is oil prices have spiked aggressively. So the anticipation is that US CPI is going to rise, right? Am I on the right lines there?
Oh yeah, totally. It's the I mean, there is a measure of CPI that strips out energy costs, but yes, the one that does not strip it out is going to be the one. Interestingly, it's actually, I think the Fed is more interested in the inflation measure called PCE rather than CPI. But yes, the broad thesis that inflation and inflation expectations is what they're targeting is bang on, and it's really being driven by oil at the moment.
So just for the traders here right now, let's say the expectations is that US CPI is going to rise because of what's happening here at oil. Are you looking more of how it's going to affect consumers? So let's say inflation without all the energy and things like that. So core inflation. Are you going to be focused more on there because that's really going to influence, I guess, PCE as well?
It is. I mean, I think you don't even have to think of it quite in those terms. It's more, whatever it is. It's even if you. I'm just trying to think how to phrase this. Even if you target the wrong inflation reading, oil is going to feed. A rise in oil prices will feed into other bits of the economy as well. Like I think the one that you teased before was airfares, but you could really see this with everything else as well. And interestingly, that's straight. I don't know how to say the word. Is it Hormuz? The
Strait of Hormuz. Yeah, I think. Yeah.
I don't think I've ever heard it said out loud, so that might be the first time. But it's not just oil. It's stuff like fertilizer as well. Travels through that, but oil is the one that people think of. But the price of other things besides oil will be impacted as well. Like, we could just use oil as the proxy. So yeah, it's undeniable that if that remains closed off, we are going to see central banks feeling the pressure to raise rates. I mean, we only have to go, because it's a big week last week with central bank announcements, and just off the top of my head, the European Central Bank and the Bank of England were two where the expectations flipped from potentially having one or two, let's say the Bank of England, potentially one or two cuts were priced in for the rest of 2026 to now, I think it's one or two hikes that have been priced in for the rest of 2026. So it was completely flipped on its head purely because of this situation that's playing out in Iran.
Yeah, absolutely. And then that obviously has, like you said, an influence on interest rates. So when you look at, would you take a look at bond yields, for instance? Would you look at the US 10-year And would you say to yourself, well, if the US 10-year is going to rise up towards that kind of 4.5%, 5% sort of area, is that when you say to yourself, well, this is definitely going to be more of like a dollar strength situation, and you'd short gold off of that expectation?
I would actually even look at it simpler than that. I wouldn't even have to go to that second order impact on the US dollar, because as we said before, there's three main factors, and one of them is actually yields. And you're absolutely right. Like, one of the things that I look at daily when I'm reviewing how markets have gone is the 10-year yield. Now, in the case of, I guess, central bank decisions, it's probably more the 2-year yield that most people should be looking at, but the 10-year yield will actually be a good indication as well. And it's been very clear for the last few weeks that 10-year bond yields for all the major central banks have been rising by 10 to 20 basis points basically every week since the war started. So yeah, once you see something like that happen, you know that if you're going to trade something like gold over a short to medium term period, your first bias should be thinking about, well, where do I find an opportunity to go short, right? Because yields are rising, US dollar is rising, the price action is all downward trend. So your bias should be, well, you don't want to go against trend until you see clear evidence to the contrary. So you want to be looking for opportunities to go short. So it's a long way of me saying I don't think you even need to think too far down the line in terms of, well, how does this fundamental factor affect the next one, the next one? You can think as simply as yields are rising, price action is down. So I want to be, I guess, if you're using your WCS method, once you go to W, actually, I was going to ask you, when in the W step, the first step, is this when you're deciding which direction you're going as well, or do you leave that open until the C?
I try and do that in the Y. So if I look at that and say, okay, well, bond yields are rising, I want to be in a simplification of it, I want to be short gold. That's kind of my Y, and then I'd move on to
that makes more sense to me.
Yeah.
No, that's bang on. So yeah, that's the way I would approach it as well. So yeah, I think in the W, it's very clear, unless you're planning on holding for weeks, which is, valid, but probably not really fitting with the profile of most of the people listening to this right now, then right now your bias should be towards going, well, okay, let's rewind a week. Clearly your bias should have been going short. Now, depending on how much you believe what President Trump has been saying in the past 24 hours about, they're very close to a deal, or we reached out to this person who I'm not going to name, but he's a very important person. If he really is very close to striking a deal, then maybe this is where we're going to see a lot of volatility and a lot of trending. But before there was any chance of a deal happening, clearly the trend was down. So yes, you would be looking for opportunities to go short.
Yeah, I agree. Because I think there is literally two narratives at play now, isn't there? It's how long this war is going to go on for, and is it, can we believe the theory of it's going to end? So for me, it's if it ends, if it doesn't end, right? So if it doesn't end, what's more likely to happen? I feel like if it doesn't end, the likelihood is that we are going to still see those kind of oil prices potentially stick around where they are now. Might go a little bit higher, but it could just stick around where it's at, which is still quite, still like $40 above where it was, which is still quite significant. I know in the UK at the moment, there are a lot of the pumps, even locally to me, in terms of just like petrol and diesel pumps, are running out, and people are starting to get a little bit. It's
happening here as well.
Yeah, people are starting to get a little bit sort of panicky in that sense. So, in that way, inflation could be a real problem. And if those yields continue to rise, then I still want to be on the short side of gold. If I'm looking at it from sort of a chart point of view, where could those moments come in? I think it's just going to come down to what happens with this little trend here. So I'm looking at this in terms of, we had a really nice sort of upward channel coming into these previous highs. We broke out of those. Actually put a post on Anzo's Instagram and LinkedIn last week where I was talking about a potential false breakout of those highs there at the $5,200 area. That worked out really nicely, and we saw a very aggressive move to the downside. But I'd be looking at kind of key levels now, 46.50 potentially, or even back up towards this 50 moving average that I've got in place. If we can kind of get up there and we see sort of small candlesticks coming in, very kind of low volatility, then I'll be looking for kind of breakouts to the downside, I think, as long as this situation remains in place. If we do see a deal come in place where, you know, I know Trump's been talking about how Iran have given him a very nice gift or whatever, or I don't know what this is.
Yeah.
But let's say it all comes to fruition and this war ends. What do we do in that situation? I think for me, that is very much a risk on scenario. And I think gold would actually probably go with that. I think we'll probably see yields coming a lot lower as things start to, I guess, the right word, normalize, I think, normalize.
Yeah.
And we'd probably see a little bit more of a rebound. So I'd probably be looking to be more on the long side of gold, probably targeting back up towards these kind of like 5,100, 5,400 areas, to be honest, because I just feel like the market is in a very, I wouldn't say, I don't know whether this is an unusual situation, because I feel like we have seen these situations in the past. But, you know, for me, with the volatility that we're seeing right now, it can be very easy to kind of see a tweet, jump on it, especially if you're trading intraday. You know, I know there was a lot of people trying to trade that kind of breakout yesterday and think, oh, this is something that's going to really last. I don't really see that. I see it as, you know, how valid is that? And how, you know, what is that price of risk? And I think we kind of touched upon that a little bit earlier as well. But those are the two kind of situations I'll be looking for, I think, going forward, for sure.
Yeah, I think that's right. I think yeah, you said there were two narratives. So I guess I would separate them a little bit into a more medium-term one and a short-term one, or maybe a long-term one and a medium-term one. So how long does the war last is obviously one, but also can the Strait of, can you say the word again? Hormuz?
Strait of Hormuz. Or
Hormuz? Yeah. So
maybe that should have been the code word at the end.
It's more like is there a scenario where the war is protracted but the Strait of Hormuz opens? And I think that's a greater than 0%. I mean, everything's greater than 0%, but I think that's a very feasible thing.
Okay.
That, you know, there's a US presence there, but that opens up. And actually, it's that second one. It's the impact of inflation expectations that are derived from the spike in oil price. If that situation can resolve, you could see the gold upward move or the gold uptrend resume without the war ending. And actually, then, you know, market commentators might then say, "Well, here we go. Here's the safe haven narrative, blah blah blah." When in reality, all it is exactly what you said. It's the yields simply normalizing. When central banks are like, "Okay, you know what? Maybe we don't have to start hiking rates," because they kind of don't want to. They have to because that's their mandate, is to target inflation. But they also know that when it's not from an overheated economy, it's not from excessive demand, it's actually coming from the supply side. So what's actually happening here is it's not like too much demand. Oh, hang on, which way around? This is my left hand, right hand. If there's too much demand, and then you're just trying to cool it down. What's actually happening is the supply is being tightened, and that's causing prices. So if you cool demand, yeah, you're getting it to meet, but you're actually contracting the economy. Like you see both of my hands went lower. And that's kind of what they don't want to do, even though they have to, because it's their job. Literally, it's their job to control inflation in the economy. So I'll be very interested as well. But as you said before, if the current trend continues, so there really is no deal, you do kind of want to look for opportunities to go short. And you had the thing drawn there before, but you want to do the classic, you know, lower highs, lower lows. So every time you see a new lower high, then on the next downturn, I can get my finger into the frame. The next downturn, you want to look for an opportunity to go short and hopefully break out lower than the previous low, take some profit there, and do the same thing. This probably works out better if I was drawing this on the chart, but I think everyone knows what I mean. And yeah, if this situation does resolve itself, you look for those opportunities to go long. I think I would actually defer to you on this because you do have more experience in this shorter term trading than I do, as to how much evidence of an upward move you would need before you were confident that this was a good entry point. I think you touched upon it briefly before.
Yeah, I think for me, I'd have to see some price action that was the opposite. So I would normally look for some kind of new high to be made first, and maybe price to kind of hold above these kind of levels. You know, if they can kind of stay above these points for a considerable period of time. So if we kind of like chop around a little bit, you know, it's almost like when we started breaking higher here and, you know, we chopped around a little bit. There wasn't really much momentum going either way. And then, you know, around these types of lows is where I really like to kind of dive in on the lower time frames and see if there's any kind of structure that's matching those moves. And this is what I tell clients to look at all the time. You know, it's always kind of, if you don't understand marrying up your time frames yet, this is something that you can do. Just grab a circle tool or whatever and just highlight all these kind of like key lows that you see in the market and go to those lower time frames. So let's say I go to an hourly chart, for instance, here. What you'll see is price starts to go from being in that kind of downward trend movement. So you can see we've got kind of like consolidation there. We break out, market's making lower lows and lower highs. What I'll be looking for here is some kind of higher high, higher low pattern. And you can see we get all these patterns. This is why chart patterns and things are so popular, is because you can see them pretty much everywhere. So like here, for instance, you've got an inverse head and shoulders pattern. You've got the left shoulder, the head, the right shoulder. But all it's really doing is showing you a new start of a trend. And all of them are doing pretty much the same thing. So you've got higher highs, higher lows. Anything above the 50 moving average for me, I usually am happy to be more of a buyer on. So I'd be looking at these kind of like patterns here where you've got a nice little consolidation. I'd probably be looking to buy the breakout of that move, if anything. Because again, once you buy a breakout there's some reasonable areas you can place your stop losses. And yeah, you can try and dollar cost average into that type of move. You know, if I saw this spike come in, I'd probably try and buy a little bit more of it and whatnot if I was there at the time trying to trade that move. But even down here as well, you can see the market breaks out. There's that pen tool in here. It starts to make new higher highs, higher lows, right? So you want to be trying to catch these little bit of movements in here, get a bit of a pullback, wait for that to change again, another head and shoulders pattern, and try and buy into those type of moves. So for me, it's about trying to identify, you know, where's those kind of like trend elements from a higher time frame and then diving into it a little bit lower. So when I was talking about this on an Instagram post the other day or last week, I was looking at this kind of range that was being built on gold. I knew I wanted to be on the short side of gold. And usually what you want to do if the market's in a ranged environment is kind of like sell the highs, buy from lows kind of situation. So I was waiting for sort of gold to fail at these highs before trying to buy into it, right? Or sorry, sell into it. So you could be looking at these kind of changes in trend, and then you have that lower low, lower high situation. We break out of the range. Look what price does. It consolidates. That to me is telling me that buyers and sellers agree at these kind of levels. And then once we break out of that, we had a very, very sort of aggressive move to the downside from there. But that's how I kind of try and see the market. I try and base myself off why the market could do something. What are the conditions around that? So the conditions here were quite nice to see. You can see that we were trying to break into new lows. Price wasn't really, you know, forming aggressive bullishness that you would typically want to see if you wanted to be long. We had a bit of a failed breakout of these highs. So that would be then, how do we apply a strategy to that? And I'd be looking for kind of like consolidation breakouts and all sorts to try.
So where your cursor is right now, right there, that's the Instagram post timing that you flagged earlier, right?
It was up here.
Oh, it was up there. Okay.
Yeah.
Well, you know what? Both of them are equally valid. So let's use the second one, the one on the right, the one that's a bit lower down. So
yeah,
everything that you said, I want everyone to take that on board because it's absolutely right. One thing that I would add, and this is like another oversimplification, but this is another reason why I personally also like this very simple analysis of higher highs, high lows, or in this case, lower highs, lower lows. If you look there and you're in that little box where the John's cursor is right now, you don't know what's going to happen, but all of the fundamental indicators are to the downside. And that was when you do the W, you're thinking, okay, it's an opportunity to go short. A great reason to do it here is because when you're trying to work out where to put your stop loss, it's very obvious where it should go. It's where John's already drawn a whole bunch of horizontal lines, right? You know, once it goes out of there, then your thesis that it's going to go down is wrong.
Yeah,
and the beauty of that is you have the structure, and it also, you save yourself the headache of trying to work out, well, because every trade you should have either an actual stop loss in place, or you should at the very least have a mental stop loss in your head of where do I admit that I'm wrong and get out of it. Because what you don't want to do is just be crossing your fingers going, well, I feel like I'm right, but it keeps moving against me. I don't know when I'm supposed to get out of it. In this case, it's very easy to know where to admit that you're wrong. And you can see the size of that. Let me get my finger in here in the frame. The size of that move compared to the potential downside, which is your profit, is so much smaller. Like the amount of loss that you would have to take is so much smaller than the amount of gain. Yeah, exactly there. Look at the size of that red and look at the size of the green. Now, of course, none of us would know that green rectangle is going to be as big as it turned out. But whatever it is, as long as that green rectangle is at least as big as the red one, then those are the sorts of trades you want to take every day, as long as you've got the green compared to the red. And I think that's why that particular time, and also the one before, I can't actually see the time scale, but from like a week earlier, that's another good one as well. Because again, it's very obvious where your stop loss goes. Like at what point do I admit that I'm wrong? And that's really what you want. You want that limited downside with the disproportionate upside.
Yeah. I try and think about where my stop's going to be before I get into the trade. It's almost like, well, where am I wrong? Because then that helps me obviously work out risk size and position size as well. And then it's kind of like, okay, well, where is the return on this? Because I at least want, at least a 2-to-1, if anything, on my position, so that I can be wrong 50% of the time and still walk away with profit. So yeah, that's great. I think, for me, like we said, those two situations could be in play at the moment. Obviously, the market is favoring a little bit more of a peace deal coming into play, and we're starting to see this kind of risk on scenario again. Because you can't see that validated, because gold prices are moving lower, stock indices are moving higher. You can see we've got like the S&P 500 here, the NASDAQ starting to just climb a little bit back to the upside. Not fully convinced over here just yet that is the case right now. But if we were to start seeing sort of like new higher highs on the stock markets and things like that, I think that's when you really start to say, okay, well, the market is coming out of that kind of risk sentiment there. So yeah, I mean, I think we've touched on some really good points in the webinar. Some key takeaways. I think we've kind of covered those just as we were looking into it. So let's get to the giveaway, because I've realised that we've been going for an hour and 20. And do you know what? It doesn't actually feel like an hour and 20. I feel like I've been
honestly, not
15 minutes.
I'm stunned at how much time has gone by. But yeah, I think there was a lot of things that people can take away from this if they made it this far.
100%. Yeah, if they've made it this far, and hopefully they have. So if you have made it this far, there's a little bonus credit and a little bit of a thank you from us. If you send the code word John, JON 20 to our CX team via the email, cx_support@anzocapital.com, you can get a little $20 trade credit for sticking with us and hopefully it was worth it as well. You get paid to get educated. How great is that? So, hope you enjoyed it. Lindsay, thank you for joining me today. Really appreciate it.
Thanks for having me.
It's been really fun to go through this topic, and yeah, we'll be back again soon. So keep your eyes peeled for that, and yeah, thank you, and we'll sign off there and see you later. Cheers, guys.
Thank you. See you, everyone.
On the court or in the markets, Performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.